Property, plant, and equipment, it's also got intangibles in there, but that's what we'll do tonight. And we might get to the chapter 5 handout, we'll see. And the chapter 5 handout is on reporting. Oops. I'll say reporting. And that's for sort of like auditing and how they do their when they're issuing their financial statements. Okay. All right, the first thing I want to do is, because we're going to be dealing with this account, is by the way, I'm going to give you guys, there's only 2 of you guys here. There should be more. I'm going to give you guys extra credit points. But anyway, that down. Comprehensive income. There's actually 2 kind of income statements. There's one, the regular income statement that we've known about forever. Revenues minus expenses gives you net income. There's another one called comprehensive income. Comprehensive income are usually things that are not yet realized, and they're usually very long-term things like pension costs and things like that. The only reason why I bring it up is that we're going to be using it today for some of the international standards. So I'm going to go over it a little bit. It actually is, there's actually 2 ways to report other comprehensive income. You can either tag it on the bottom of the income statement, which a lot of companies used to do, or you can make a completely separate statement that includes those things that are what they call other comprehensive income. You may have gone over this in other classes, I'm not sure. Okay, so this is our regular way that we do our financial statements look like this. We have our net income, it goes into our retained earnings, and that goes into our balance sheet. Okay, so this is the normal way that we do it. Now, comprehensive income, let's make it a different color, green, does not go through the income statement. It goes directly to the equity section. So there is no intermediary retained earnings thing here. And when a company talks about earnings, earnings do not have other comprehensive income. It's kind of like it is kind of an income statement, obviously, but it's not. When the company talks about its earnings, that's not what it's talking about. It's talking about simply the normal income statement that we're all used to. So, coming down here, you'll see that we'll have the retained earnings. These are things that went through the income statement. Shuffle in here. And then we'll have our other comprehensive income, and this did not come from the income statement. It went directly into it. Okay, now you say, well, what is this other comprehensive income? Why do we even have it? Well, usually there's 2 ways they come about that it goes from being comprehensive income to being either on the income statement or it disappears. The Net income, when they are realized, when some of the stuff on here is realized, whatever it is, it'll go on the income statement, and then sometimes it just appears because of market conditions, which we'll talk about in a second. Okay, so here are some of the common things that you're gonna see on there. This is under GAAP. And you see they're kind of wacky stuff. You know, unrealized gains and loss on debt investments classified as available for sale. It's pretty specific. Gains and loss on cash flow hedges. Okay, it's kind of weird. Foreign exchange gains and losses, which we'll do here later. Pension gains and losses, those can be huge dollar amounts and they can fluctuate quite a bit. And under IFRS, the revaluation of assets, which we're going to talk about. So this is, you know, it's a kind of a separate statement. It's not part of earnings. For years, the United States was the only one that had comprehensive income, and I always hoped that it would go away, but quite the opposite happened. The international standards started using it, so it's not going to go away anytime soon. But it is kind of wacky that it's a separate kind of an income statement for usually for kind of strange and really long-term things, and especially things that are in flux. It may go, you know, one way or another. For instance, foreign currency exchanges. Sometimes it goes in your favor, sometimes it goes against you. It can change from year to year quite a bit, and they don't want it to fluctuate too much on your regular income statement. Okay. So we're going to get into property, plant, and equipment. And this is for the international standards. Ciphers. And the first two here are the same as for GAAP. Oops. This one, estimated cost of dismantling and removing the asset along with restoring the site. Okay, that's not GAAP. So this one is not GAAP. You know, we don't look into the future and say how much is it going to cost to take this thing out once we're done with it, or whatever. And I suspect that unless it's some really strange large asset, probably not that big of a deal. But anyway, the international standards say that is part of the cost of that asset, the future cost of pulling it back out. What we would, you know, probably call the take it out of the residual value of it. Okay. Exchange of assets. This is the same. This is the same for GAAP as it is for IFRS. Fair value, unless no commercial substance can be determined. We're not going to go into that. But there's actually quite a bit in this chapter. This chapter could probably take the entire semester if we really went into all this stuff. But anyway. International standards, measurement subsequent to initial recognition. Okay, so this is the two treatments you can use for your long-term assets. The cost model, this is exactly what we use in the United States. You know, we have the depreciation and blah, blah, blah. The revaluation model. Fair value minus subsequent depreciation. So this is not the cost, this is the fair value of it. I have a couple other rules here. Increases in value go to the other comprehensive income, which we just talked about. But I want to talk to you about why they have this, the revaluation. For US standards, we use historical cost. So if I bought, let's say a company bought a building in 1981, they bought the building for $600,000. They're going to be depreciating it based on the $600,000, and it's going to be carried on the books at less and less and less. So maybe fast forward 30 years, this building's on the book for $100,000, and the market value of the building is $7 million. They bought it when it was $600,000 when they bought it, but now it's a $7 million building, and it's probably generating revenues like a $7 million building. So notice you have this ridiculous number, $100,000 on the book for this building that's really worth $7 million. Now, the $100,000 is a lot easier to trace. You can look at the purchase price. You can say, okay, this is what they paid for it back in 1981, and be sure that that is the price that they paid for it. The problem is that number is completely irrelevant. So international standards allow for the revaluation of assets. They say, look, we had to give people who read the financial statements, some more reliable numbers. Not reliable, it's a bad term. More relevant numbers, relevant to today. Yeah, the 600,000 is reliable. We can, right down to the penny, we can look at it, but it isn't really relevant to today. So they're looking for more relevance in the numbers. So that's why they say you can revalue it. So you can revalue it to, whatever the market value is that you determine. Now that's going to be an estimate, but it's going to be much closer to reality than $100,000. So let's go ahead and take a look here. Okay. Decreases. Okay, well, we'll get to that later. Okay, so here is a problem that we have. So proportional to value, eliminate shortage excess against asset account. Okay, so I gotta send you guys one more thing. Maybe I don't. I don't yet anyway. Okay, so proportional to new value. So okay, so let's take a look at this. So we have equipment in the equipment account. So this is what they have on their books. Okay, this is the top. Okay, so this is what we have on the books. Now we look at this and we say, wait a minute, this thing is not worth $300,000. The revaluation, let's say, comes out to 520. So here we have this equipment on our books for 300,000. But the subsequent reevaluation says it's 520. It's worth 520,000. Whatever it is. Okay, so the question is, well, let's first go. How much of a gain do we have here? We got it at 300,000 on the books, and now it's worth 520.
220.
Yep. Now this is going to go into other comprehensive income. So this will be a gain, probably on revaluation, but we'll say gain of 220. Oops, let's put the right amount in here. And again, that is the 520. It should be a dollar sign. Minus the $300,000 carry value. Okay. Now, this equipment account has 400,000 in it. And we want to get that up to 520. So we're going to add what, 120 to it? That'll get that up to 520. And the accumulated depreciation, we're going to take that away. So we're going to take away that accumulated depreciation. And net income is not going to be affected at all, because if this is and the idea is that this is long-term stuff, this is gonna last for 10 years or whatever, and eventually it is gonna go down to whatever, be useless someday. But these are gonna be, oh, you need another zero there. So here's what this is gonna look like when we're done. I'll put it down here. When we're done, this is gonna look like this. It's gonna be 520,000. This is gonna be 0. This will be 520,000. So that's what a revaluation will look like. Now, one of the reasons why you have to think about these, and I should have the journal entry here, I didn't put it on, but one of the reasons why you have to think about these things is you're doing the books, you're working for a US company, and they have this foreign subsidiary that did this transaction. When those financial statements come over to be mixed in with your GAAP financial statements, you're gonna have to reverse that. So you're gonna have to go ahead and reverse out those journal entries that they have, for writing that up to 520,000, because US, we use historical cost. I'm not saying it's right that we use historical cost, but I'm saying that's just the way it is. So, one of the reasons why we get into what would it be, you might reasonably say, well, who cares that they do their books different than we do? But the reason is because when you have a subsidiary, especially when you start combining those numbers with the US books to consolidated financial statements, you need to know how to undo that and get it back into US standards. So this is the way they showed it on their books. After we undid it, it would look like this again. Okay, another kind of a strange, let's say strange, but a difference is actually, it's not strange. I think I like the international standards better on this. So here's the thing. Problem number 2. Purchase land and building for 700,000. Now we all know that land does not depreciate. Buildings do. So we have to separate these out. Let's go ahead and do that. So GAAP depreciation for land would be 0, infinite life. Building. 40 years, 500,000 divided by 40 years is some number.
12,500.
12,500, thank you. So this would be our depreciation expense. Under GAAP. International standards are a bit more thorough. And they say, oops. And they say, no, you didn't just buy a building. The building has a heating, cooling system, which doesn't last forever. There's fixtures like things like signs and railings and all that kind of stuff. That have a shorter life, and so you have to break them up by components. So this is where it differs a little bit, and quite honestly, fairly reasonable, I think, as far as getting an actual depreciation number here. Okay. Copy this down just land is going to be the same. Zero. But heating cooling system is 50,000. Let's divide by 20 years. Uh, 2,500.
Yeah, that's what I got.
Okay. Okay, fixtures are 10,000 divided by 10 years. So that's 1,000. And the building is going to be 440,000 divided by 40 years. 1,000. Okay. So depreciation expense is going to be 14,500. So this is what it'd be under IFRS, it'd be 14,500. And notice that as time goes on, after 10 years, they're going to have less depreciation because these will all be depreciated completely. After 20 years, the cooling system, and so these are going to have different lives for them. I think I'm going to go ahead and send out the debits and credits thing. See why I missed it, I didn't put it in there. And this is just kind of a recap, kind of, I know you guys have done this before, but kind of a recap of debits and credits and how they come about. The first page is a more detailed one. And the second page is kind of generic. Yeah, so because sometimes sometimes you don't know what the liability is called, but you know it's a liability. So or I mean, there's things that are, they don't fit into the nice payable or unearned revenue thing. Okay. So here we have our, I don't have depreciation expense on here. What moron made this up? All right. Well, anyway, I'm looking more down here to the accumulated depreciation accounts. Those are credits. Now notice, going back to going back to this. If we had to make an entry to put this back into the US kind of standards, the original entry that they would have would look like this. Oops. Depreciation expense would be 14,500. And accumulated depreciation 14,500. Oops. So this would be the IFRS. So this would by the way, if you had me for, you probably heard this before, but you remember the order by DE? Kind of morbid, very, very morbid. But at the end of his life, it's going to be dead. So DEAD. So the depreciation expense and accumulated depreciation. This is a normal journal entry that you'd have. And if you look on here, the accumulated depreciation is going to be a credit. So that's what kind of we're talking about. And in my foolishness, I didn't put depreciation in here, but any other expenses, I guess, would be there. So those are going to be debits usually. Okay, so what adjustment would we have to make to this journal entry to bring it into GAAP, to make it like the GAAP standards? So here's the GAAP. Here is the IFRS. So what would the journal entry look like to get this back to GAAP standards? They put 14,500 on. When we put it into GAAP standards, it's only 12,500. So what would be the adjusting entry for this? Get a little more room here. Anyone? Oh, come on. What's the difference in the expenses? Oh, you guys are toying with me.
2,000.
Yeah, so we have to take 2,000 out of it. So what we would do is just reverse this. It should be justified. So we're gonna take out a depreciation expense. $2,000. And same thing with accumulated depreciation. Oops. Spell it right, I think so. That is not to be. Okay. So this would be the gap adjustment. We would be backing out. Basically, we'd be undoing this by $2,000 to get it into gap. And so after this would be, that number. Okay. When it comes to kind of combining these, I had a friend that used to do these all the time. That they worked in a place that had places all over the world. And he always called it unmixing a cake. They have all their stuff done exactly as supposed to, and then you gotta, unmix it and put it into our way we would do it. And sometimes one of the things he would do is if they did it, if they have a different standard, you just back out everything they did and then put in the US standard. So whatever journal entry they made, whatever it is, you just reverse that out completely and then put in the US standard. Rather than trying to figure out this, what would the adjusting entry be? Just take this out completely, reverse that out completely and then just put in for 12,000. You work out the same. Okay. But sometimes though, the CPA exam, they have asked like, what would be the adjusting entry to something? So even though that would be the way to, that might be a good way to do it. On the CPA exam, they're not always so nice about it. Okay. Derecognizing carrying amount of property, plant, and equipment, kind of a funny term, but this is when you have something that you're not using anymore. So if you have an asset, I did something funny here. I don't know how to get out of this. No. Oh, I know. There we go. Sorry about that. I forgot what I was talking about. Oh, it's when you stop using something. So let's say you stop using something. US standards. You stop using something. So let's say you got a calculator. Okay, I'm not gonna use this calculator anymore. I got a new calculator. So I put this calculator would then go into other assets. It's not gonna be part of property, plant, and equipment because it's not being used anymore. It'll be in other assets. International standards act as if you had already sold it, because maybe you're waiting to sell the calculator, sell it for buck or whatever it is. But International standards say, no, you take it completely off the books if you're not using it. Act as if it is sold, but an estimated amount, but it's removed completely from the books. There is no asset anymore on the books that you're not using. So that's different than the US standards. US standards say you put it in the other asset account, and when you figure out a buyer for it or whatever, then when it's realized, you take it off the books. International standards are a little bit different. They say, no, you can't count that as an asset because you're not using it. So international standards are that you write it off as if it was sold, and for whatever the market price you can come up with for it, you can even recognize a gain on it. But you're taking it off the books completely because you don't want to put it on the books as an asset that really isn't being used. US standards, a little bit different. You put it in the other asset account, and when you sell it, then you recognize any gain or loss on it. So a little bit different. Okay, I see an error already in this one. So it's going to be valuation of property. Change this word here to property. Okay. If the item that you're revaluing is investment property, so you're using it as an investment, not in your business, but as an investment, either you rent it, or maybe you're just holding on to it to see, if you think the market price is going to go up. For property, it's a little bit different in that it would be, the change will go right into net income. So this would look like this. I gotta change all these to equipment. This is a copy and paste problem. The property account change. So to change these, sorry. So the property account, again, just like we did before, this would be add 120,000. Cumulative depreciation change would be less. $100,000. This would not go in other comprehensive income if it's an investment property. Not something you're using in your operation, but an investment property, it goes right to income. Oops. So this would have to be reversed out for GAAP. We'll go ahead and put the IFRS, how IFRS would do it. And then I'll just say we'll reverse it out, once we know what the original entry is, it'd be easy to reverse it out. Okay, so let's see, the property account. The investment property, yeah. Increase the accumulated depreciation. will decrease. And so that would be the journal entry. Now, for this one, we don't allow for any of that for US standards, so you just reverse out the whole thing. Question on that? And if you're wondering why, it's because this is an investment property. You know, an investment property could be investment in stock, it could be investment whatever in it. So the idea is that you're going to make income on it as time goes on. You know, unlike property that you're using in your operations, this was made for making money. You know, that you made this investment to make money, not to use to store your goods or whatever. So the idea is that this is an investment, and that the investment, as time goes on and you can get a fairly good market value for it, whatever, that it increases in value, that you should put that on your financial statements. And also because it would be understating the assets if you didn't. You know, that's all, and that's one of the real differences between the IFRS and GAAP. IFRS says we need to have relevant numbers. You know, GAAP says we have to have numbers that we can actually check on, you know, that we can check and see what the price was they paid for it and all that kind of stuff. So there are differences between those two. And the differences are kind of they're more like social almost. You know, I've been in meetings where, you know, we talk about accounting rules and stuff, and you tell them, well, you really shouldn't do that. Well, can we? You know, it's that kind of idea that, you know, well, yeah, I know it's not right, but can we do it? I mean, are we gonna get arrested if we do it? If we're not gonna get arrested, then, you know. So you do run into that kind of a scenario sometimes, you know, especially dealing with, you know, I worked at Navistar and US Steel and those two companies that had international stuff. But the Navistar one was kind of funny because we had a Canadian assembly plants in that, and their attitude was way different. You could tell it was different. You know, they want to do the right thing. You know, even, you know, well, I don't think it should be valued at that. We got to write that down because I don't know. You know, they're a very different kind of mindset than the US standards. And two, you got to remember too something about when it comes to with me doing stupid stuff with Zoom. When it comes to us as far as accounting, we don't actually, you know, the operations are whatever the operations are, right? I mean, whatever rules you use, yeah, they can come up. But just because we say it's income and they don't, doesn't mean, you know, that it's necessarily right or anything like that. We don't actually make, you know, income or losses or anything else. We're basically there to report on it, whatever the operations are. So these differences are not necessarily, they're for the most part timing differences. And they're also not necessarily 100% accurate as far as what, you know, anyone given what was really going on in the operations. They can't be. All operations are different and all that kind of stuff. So, okay. impairment of assets. And this is, we do it both for GAAP and for international standards. But we have a little bit different way of doing it. And the difference comes from this. To see if something is impaired under international standards, we use the present value of future cash flows, sometimes called the or commonly I would say called this discounted. So this is so discounted cash flows is used by IFRS. And I'll show you what I mean in a second. US GAAP uses undiscounted cash flows. Okay, so coming down to this one. We have a patent that has a carry value of 28,000. Okay, so we got the books for 28,000. We're looking at the expected cash flows. The undiscounted cash flows, one that we use for GAAP, is 30,000. The discounted cash flows they use for IFRS. Let me put that on here. So, and when I talk about the discounted or undiscounted, I'm talking about the present value of money. So present value, what I mean by that is that money in the future isn't worth the same as money today because of inflation. Money that a dollar you get a year from now is going to buy less than a dollar today. So the discounted cash flows say, okay, what amount of today's dollars would a dollar a year from now say? So in that first one, that first line, when you got the the $10,000 for the first one, but $9,090, what they're saying is that a year from now, that dollar, those that $10,000 will buy the same as $9,090 today. So putting it into today's dollars and future dollars, you can't really compare too well. GAAP standards allow for undiscounted amounts. So a dollar today, they say, is the same as a dollar 3 years from now. International standards say, no, you have to discount them to get the actual amount. The international standards on this one are more in line with finance theory and econ theory than the US rules are. The US one is definitely easier to use because you just have to get the numbers and add them up, whereas this one you have to jump through a few hoops to discount it. But anyway, so here it is. So the question is it impaired? Oops. So for GAAP, carry value is less than the undiscounted cash flows. Is it impaired? No. According to US standards, we have in the books for 28,000. It's undiscounted cash flows are 30,000. It is not impaired. It's worth more than the future cash flows. Get rid of this. It's already down below. I'll talk about that in a second. It's a little bit of a complication to this one, but it, okay, for IFRS. Carry value is this. The discounted cash flows are 24,000. So it is worth less than the discounted cash flows. I did that wrong. It's higher than the discounted cash flow. So this is what the cash flows are going to be coming in. This is what we have in our books for. So this is it impaired? Yes. And the impairment amount would be how much? So this is the value that we're saying that it's worth. Uh, 3,160. Now there is a little bit of a complicating thing here too, though. IFRS even has one more hoop we can jump through, and that is if we can sell it for more than, you know, if the net realizable value, the selling minus selling expenses, if we can sell it for more than the 28,840, that's the number we can use on it for the net realizable value instead. Now, it'd be hard to imagine something that is impaired that would go sell for more than the cash flows, discounted cash flows. But it's possible. You could have, you know, there is imperfect markets all over the place. So it is possible that maybe even though this thing, you know, we have books for 28,000 and the discounted cash flows are 24,000, it is possible that there might be someone willing to give you 25,000 or even, you know, more than that. It may not be impaired at all, depending on the net realizable value. So it is possible using the net realizable value that it would change it. So it really is, you know, the discounted cash flows or net realizable value. And because we have imperfect markets, that could actually, what time is it? Ooh. Give left. Okay, let's stop here, then we'll come back and finish it. We shouldn't have too much more to. Be back at say 7:10. Okay. Okay. Reverse of impairment loss. It can be reversed under IFRS. But only up to the original carrying amount. So no revaluation. So if there's an impairment. Okay. Intangibles. And intangibles are somewhat of a problem. Hey, that's not me. It's my dog. That's me. There's a problem with intangibles, especially things like patents, copyrights, all that kind of stuff. Excuse me. Something like 99.9% of patents are worthless. While they meet all the criteria to be a patent, there's no actual value to them. And so so the same is true for companies. So they're doing the research and development, and they're creating patents a lot of times. I read something that I think that in Germany, the auto companies that are there, they're registering something like 10, 15 patents a day. So I mean, there's tens of thousands of patents now, that they're literally like 10 a day of patents being filed. Most of them are worthless. So here you have companies putting in a lot of times huge amounts of dollars into something that might very well be worthless. So the US has always said, okay, research and development, that gets expensed because most of the time it's going to be worthless. The only thing you can capitalize are the legal expenditure, so registering it. A patent, that you can capitalize that, but all the research and development up until then, it has to be expensed. And for the most part, the research stuff is the same as in the international standards. However, they do have development costs that can sometimes be capitalized. So they can be carried on their books as an asset. Now notice that, you get the doing credit thing. So US standards say you expense them. International standards say that some of these development costs, you'll actually put them on as assets. So instead of having them as expenses, they'll be assets. Now they'll both be debits on your journal entries, but one debit is for expense and this one is for assets. So if you don't debit the expense, obviously your net income is going to be higher. You cannot see what I'm doing. I just realized that. I am so sorry. Share screen. Let's do that again, Mark. Okay. So expenses and revenues, expenses and assets are fairly closely related. And if you're wondering how, why this is set up like this, it's because expenses and assets are things you pay money for. This is money going out. And on this side over here, this is all money coming in. Oops, let's change it. This is how you get money. How do you get money? You sell something, you borrow money, or you get it from the owners. Over here is how you spend it. You spend it on expenses or assets. So development costs in the US, those are expensed. In international standards, they can be treated as an asset. So notice that if the expenses are lower, because you're treating it as an asset, that means your income is higher. Okay. Now, purchased intangibles are different than internally created ones. And purchased intangibles have a value. You don't know that about internally generated ones, but purchased ones, if you're buying it, if you're actually buying this, it must have a value. So these are not worthless. These intangibles are not worthless, whereas these internally ones might be. And the gap and IFRS are basically the same for these two. There's nothing too thrilling about them. But there's a difference between an asset that is internally generated and one that is purchased. One that's purchased, it must have a value. You purchase it for a reason. One that's internally generated, you don't know if it's worth anything or not. So there is a big difference between a purchased one and an internally generated one. And these are the problem. Okay, so international standards, they have some criteria that must be met for the development cost to be capitalized. You can't just capitalize all of them. It has to meet these criteria, and they are pretty good criteria to do. Whatever you're developing must be feasible. You must have the intention that you're going to go through with it and the ability to do it. So it has to be that you can do it, you're intent on doing it, and that you actually have the ability to do it. That there's some probability of success. A market, there's somebody you can sell it to. That you have basically the resources and that to bring it to market. And to reliably and measure the expenditures. In other words, that they're not all combined with something else. That you can separate out expenditures for whatever this development is compared to other ones. You can't just have one product that's being developed and throw all the costs into that, because that one is more likely to be a winner, and then put all the costs from all the other ones in. So it has to be, you have to be able to separate it out by product, basically, and all the rest of these have to be met for that one product. So it isn't that you can write off anything, but this is different though. And these can be hundreds of millions and billions of dollars worth of stuff. So you have these two standards, and these can be huge. One for the US standards, which say you expense everything, and the international standard where you can capitalize it. Where this comes into play is a lot of times pharmaceutical companies. If you take I should pull one up. I'll pull one up next time. If you have pharmaceutical companies that make drugs, they have massive amounts of development, in the billions and billions of dollars. And when they do come across a product, that works, and they, develop all that, it's worth billions of dollars. So you have this real difference of that you could have a company that looks very profitable on international standards and actually losing money on US standards, because of these development costs. So they can be this massive. If you look at the drug companies in that, their intangible assets are oftentimes 80% of their assets. They'd be worth tens of billions of dollars, and most of that is in intangibles, the things you can't, they don't have a substance. Okay. So what are the effects of this? Well, the IFRS income effects. Now, again, we really are talking about timing differences. Virtually everything gets expensed at some point coming through a company. So we're talking about timing differences, and that, so when we say that their income is higher, it's going to be higher for a specific period, but in the future, all of it kind of levels out, because in the end, we cannot change that we're all working off the same company's actual performance. Okay, so IFRS. They have higher income. And that also inflates the retained earnings and shareholders' equity. And yeah, we have to back that stuff out if you're bringing them over to the US ones. So, yeah, the balance sheet effect is that you actually have more assets. And that you have more sitting in retained earnings because of it. To the same extent, right? If you know, like our balance sheet. Here's our balance sheet down here. If you do something to one side, you have to do something to the other. So it's an equal amount. This is another big one. And this one is a little bit more serious, I think. You know, these up here are timing differences. These down here tend to be a little bit more problematic. Operating cash flows are oftentimes even more important than income for a company. Now, expenses go under operating cash flows. So US standards, these will be expensed. International standards, those are seen as assets. They are simply purchase of assets, of long-term assets. And so it'll be an investing cash flow. Now, both of these will be money going out. You know, these will be cash flows leaving. However, one will make it look like you're operating at, you know, much lower operating cash flows than the other. Again, these can be billions of dollars. Okay. Problem 5, a subsidiary that uses IFRS capitalized research and development costs totally 45,000. What would be the consolidating journal entry for the parent company that uses GAAP? So what would we have to do for well, so they capitalize this 45,000. And we would expense it using GAAP. So how would we change that? We have to undo the expense and take off the asset. I said that wrong. We have to take off the asset and put on an expense. So what would the journal entry be?
Would it be credit the asset and debit the expense?
Yep, perfect. Yeah, so whatever the asset whatever I don't think I even need to do it, did I? No. Okay, so this would be. You just call it R&D, that's fine. 45,000. And whatever the intangible asset is, whatever they call it, capitalization, it could be a, you know, some kind of intangible or whatever it is they're working on, but. Yeah, so this would take it off the books for as an asset. and then expense it. So international standards say that they're buying an asset. US standards say, no, that's money going out the window, you're expensing it. I had a friend that worked for an IT company. He was in California like years ago, like in the late '80s or whatever. He was involved with making bubble chip memory. Well, I've never heard of that. You never will either. It was memory that you know, for like computers, you can make a large amount of it very cheaply, but it is extremely slow. Well, who wants to have slow, you know, computers or phones or whatever? So even though they got, you know, they got a number of patents on it was kind of funny because he was talking about it, like, you know, by the time he was there, he's like ready to give up on it because but they were still trying to develop it for some reason. But you know, nobody wants slow memory, so it was one of those things that even though it met, you know, all the research and development met all the criteria for a patent, you know, and I'm sure that there's still, if you look it up, there probably is some kind of bubble chip patent out there. It wasn't worth anything. Okay, well, I think, you know, let's go ahead and push on to chapter 5, because I think that one's fairly short. I think it's only 2 pages. And then, so what we'll do is next week we'll do some problems, and then I'll give you guys some problems that'll be similar like on the exam. And we'll have a test on chapter 4 and 5. So I'll send that out next week. But I do want to do some more problems on these, just to, you know, the handouts kind of show you how to do it, but it's one of those things it usually takes more to really make it stick. Okay, so chapter 5. And most of these, most of the current liability stuff is very much the same. You know, they have a little bit different wording, but the actual practice of it, is very much the same. For instance, current liabilities, it's going to be settled in a normal operating cycle, and this is usually 1 year. Held primarily for the purpose of trading, things like accounts payable and all that kind of stuff. Settled within 12 months. That's the 1 year rule. No right to defer until 12 months after the balance sheet date. So in other words, you can't defer the rights to them within the year. Okay, now here is where it gets tricky. And it gets tricky because this is kind of a new thing that is going on that is kind of risky. In your finance or econ classes, they would always tell you that you match, you match long-term assets and, you know, development costs with long-term liabilities. You know, if you buy a building, you get a long-term, get a mortgage, right? A 30-year mortgage or whatever it is. So you're matching a long-term asset building, it's gonna last for 30 years or more, with a long-term liability. And that's kind of, you know, the matching of the financing and the actual asset, the capital expenditures like they tell you. Short-term, you know, you use short-term financing for short-term stuff. So you have accounts payable for buying inventory. You don't get a 30-year mortgage on inventory. You match them up. Okay, well, here's the thing that is kind of topsy-turvy in today's market, and this is very strange. That in the past, short-term borrowings were always less than long-term. Because the idea was there's less risk. So, if you borrow money for a year, you pay 4%. If you borrowed it for 30 years, you'd pay 6%. So the longer the time period, the more, Well, companies have kind of lived a little bit on the edge in that they said, okay, well, I'm gonna have all of our long-term borrowings, and if we want to pay less interest, we'll just have a short-term 1 year borrowing for our long-term assets. So we buy this building, it's gonna last for 30 years, but instead of getting a mortgage, we're gonna get a short-term note that will be for the entire amount, but only be for a year. And because it's only a year, it's gonna have a lower interest rate. And they'll just refinance it every year. So for the next 30 years, we're just gonna keep refinancing this thing for however many years they're gonna do it for. So a lot of companies have been doing it, and it's risky. It's risky because first of all, the interest rates can go up, which they are now. But B, there's the possibility that you can't get the refinancing. And you have this weird thing in the market now where short-term borrowings have a higher interest rate than long-term. It's a very strange market because there's so much demand for the short-term borrowings that they're actually driving the interest rates up. And you think the companies that now go to the longer term because it is a lower interest rate. But anyway, this is a very common thing that was happening. So these short-term borrowings are a real problem because they would be current liabilities on the books if they don't get refinanced. Okay, so to get them refinanced, they have to be able to be refinanced in the next year, or else they're going to be counted as a current liability. So, so what happens is, I give you the example here: a 10-year finance new factory instead of finance a 1 year short-term loan, refinance it. Okay, IFRS rules are this refinancing must be done and completed in writing by the balance sheet date. The GAAP rules are a little bit more lenient, and I'll show you why. That if you do it prior to the balance sheet being issued. So for IFRS, it's by the balance sheet date. For GAAP, it is by the balance sheet being issued. In other words, the balance sheet, the release of the financial statements. Okay, so this is kind of what this is like. Keep doing that. My little focus dog. My focus dog. Oh, there's the focus dog. Okay, so here's what they're talking about. Okay, so here's let's say this is there's a bug on here. See him? Go away, bug. So here's January 1st. Here's December 31st of the year. Now, at the end of the year, a company gets audited. And somewhere over here, let's say on February 15th, I think I used that as an example. So this is January 1st, 2022, and this is 2023. So they get an audit done on the financial statements, and this is when the financial statements are done, are issued. So GAAP says they have until this date to get their financing squared away. international standards say, no, you have to have it done by the end of the year, or else all that gets counted as a current liability. So, the two different, so IFRS is actually a little more strict. They say, look, by December 31st, you have to have all your ducks in a row. You have to have your financing. If you get it done in here, it doesn't matter. It's what you had at the end of the year. GAAP says, okay, by the time you issue the financial statements. I think that this is actually the date of the audit report, which is the last day of field work, actually. I think they use the date of issuance. The date of issuance and the date on the audit report are often two different things, but they're usually a few days apart. But anyway, so for GAAP, they have until financial statements are out, and for IFRS, it's at end of the year. And so this is what they're talking about here. So, yeah, so the balance sheet. Okay, a payment on demand due because we want to violation of debt covenants. Okay, so if you violate a debt covenant, and how do you deal with that? That it's on demand. The same rules is up here. You have to have your ducks in a row by the balance sheet date. US GAAP by the annual report issuance date. So these are the same up here. Should be the same color though. What are they doing? So the same rules apply to, suppose that you get behind on your payments or whatever, and if the whole thing is due, it's going to be a current unless you have some plan in place. And this one probably doesn't come into play too often, but if it does, if you have any bank overdrafts, international standards are that you net them with your cash, so to subtract it from your cash. US standards are you carry it as a liability. So, international standards are kind of like this. They'll say, okay, do a decrease the asset. US standards are you increase your liabilities. I can't imagine that comes into play too often. It does. Okay. Now, any question on that? So these aren't big things that are. I can't imagine these are too. Well, this one right here will be a big one. This right here is a major one because of what companies are doing. In your finance classes and your econ classes and all that, they'll tell you that, don't do that. You're taking on more risk than you should, but it's very common now. So, and really the reason for doing it was in the past was you have reduced interest payments, although lately that really hasn't been the case. So I'm not sure why they still do it. All right. Contingent liabilities. And some of this is because some of the differences in between these are kind of like the differences in the legal system of international to United States. International law is much different in the United States. I mean, there's a lot of times they don't get huge judgments. They don't get $9 million, $10 million, or whatever. They don't get those usually over there. They do it for a reimbursement, place, part and all that, but they really don't have the kind of legal system we have here. They go by a set of kind of rules of what they pretty much know what when they go into a lawsuit or something like that what they're going to come out with. It's pretty much standard. They're almost lawyers in Europe are almost like in other countries are almost like accountants. They got to know the laws, right? But you know, everything kind of fits into the law, and they're just kind of there to make sure that the laws are followed, and, you know, they you know, do all their stuff, their background stuff to try to get fitted into this category or something like that, but it's not like the, you know, presenting to the jury and going, getting emotional and big speeches and all that kind of stuff. It's not like that. So a lot of times so if you think about it, their risk of law problems or lawsuits and things like that, things that are contingent liabilities or contingent on something happening in the future, are much less. They get sued, no doubt about it, but the lawsuits are generally pretty much known. It's pretty much known, okay, you're gonna get, they pay out about this or that, whatever it is. They have different guidelines and all that. So it's way different in the United States. And that's one of the reasons why we have these different estimates when it comes to lawsuits. Because in the United States, they can be absolutely huge. And in other countries, they generally don't run into that. So if you're wondering why they're, can be fairly different, that's why. Okay. So international standards. I don't know why I put IFRS in there twice, but it's not wrong. Most of the stuff is very similar to what we have in the United States. Down here, they also have a thing called a constructive obligation, arises from past actions or current statements indicating that the company will accept responsibility. Now, this is something we don't do in the United States. Whatever they did in the past, we don't generally take that into consideration. So this constructive obligation is something we don't really do in the United States. And one of the things that rarely happens in the United States. And it rarely happens in the United States because of these huge lawsuits. People never come out and say, "Oh yeah, you got us. We're gonna, we're guilty." You don't get that. You don't get it because the ramifications can be huge. Okay. So when it comes to contingent liabilities, there are a few things that are different. And when it comes to things that are contingent liabilities, when you talk about probability, it's more likely than not for IFRS. And yes, I don't know how they came up with this, but it's 70%. Why isn't it 71% or 64%? I don't know. But this is what it is. Okay, down here's where it gets a little bit interesting. When it comes to how much do you book for these, IFRS uses probably weighted average. US standards are the low end of the amount. Okay, so how does this work out? So let's say there's a contingent liability, and you talk to the lawyers, and the lawyers say, okay, there's a 20% chance they're gonna pay out $1 million, 50% chance 2 million, and a 30% chance be 5 million. There's a total probability 100%. Okay. And so we weight these. Hopefully I did the math right. I think I did. So probably a weighted average would be 2,700. Okay, so, or excuse me, 2,700,000. So this would be the amount for the IFRS. Ooh. So IFRS takes the weighted expected value. US recognizes the low end of the range of possible amounts. Okay, so this is international. This is the low end of the range of the amounts. This is what the US standards would have. Now, you might say, why do we do the low end? You know, why is it the low side? You know, for US GAAP, why do we have this on the low side? Well, it comes down to companies and businesses not wanting to admit responsibility for higher amounts. And you can imagine that in US and the courtrooms and so on, you know, if you were to put that on your financial statements, you owe 2.7 million, you know that some lawyer is going to point at it and say, well, they even admit to owing at least 2.7 million on their financial statements. You know, those are the kind of things that you don't want to have happen. You know, you don't want the financial statements to create a loss based on what you're reporting. So that is one of the quirky things about the US one is that you always take the lowest estimate. Now, you say, okay, well, that makes sense. It gets even a little bit more convoluted though. In that for IFRS, if they think that that is going to happen, they can omit the disclosure if it can be expected to prejudice the seriousness of the position of whatever. So they actually have that you can, if you think that that's going to happen, that someone's going to be able to point to it and say, look, you're taking responsibility, you can omit it. In other words, not put it on completely. Which is, you know, so it's either usually higher or it's not there at all. If they think that it's going to prejudice a case, they can actually admit it completely. So that's another weird, you know, kind of cultural thing. You know, I say, well, no, you can't omit it. You know, if you have this probability that you're going to be paying out, you can't just simply not put it on. But the IFRS is a little more judgmental. They say, look, we owe zero on this, and maybe we owe something else. But again, they can omit it if it's can be shown that it'll likely disrupt their legal standing. So I think that's it for this one as well. Hey. Okay. So those are some of the differences between the countries, and so we'll do problems on chapter 4 and 5. Probably not too much on chapter 5. So well, maybe a little bit, but chapter 4 certainly I want to do some more problems out of it, and maybe not maybe we'll definitely do some multiple choice stuff out of it before I send out the exam. There actually is there's quite a bit in here, as you guys can see. Any questions? I think there's drops for. See here. I think I got the assignments up. Yep. Okay. Sure. And I will also. I'm going to throw in some extra credit points for you guys. Okay. Any questions? All right, we'll pick it up next week, and then next week they'll send out the chapter 4 and 5 exam, and that'll be the first exam. Okay. All right.
Have a good night.
Good evening.